Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for our third anniversary together doing the monthly RIA update is Chris Englebert, founding partner and chief investment officer of Englebert Financial. Chris, it's great to see you as always, and we've come a long way since our first segment on the PHLX trading floor. Welcome back to Trade Talks.
Yes, Jill, thank you very much. And I just wanted to give our viewers some interesting statistics. So back when we did this in August of 2017, the S&P was trading at 2471. Today we're 3370, give or take. That's a 36% gain in 3 years. The Nasdaq, even more stunning. When we did this back in August of 2017, the Nasdaq was trading at 5988. Today it's over 11,100, a stunning 86% gain. Some of them aren't that big of changes. For example, oil was trading right around $47 a barrel, and right now it's trading $42 a barrel. But another stunning number is the 10-year Treasury. Back in 2017 was 2.12%. Now it's trading at 70 basis points. So what a change over a 3-year period of time.
Certainly is. And what's the biggest change for retail investors over the last 3 years, besides what has been happening with the 2020 pandemic and economic shutdowns?
Yeah, I think the biggest change is what I call old tech versus new tech. And this has been really come to the forefront now. Obviously the COVID and the pandemic and the work from home has gotten people to understand. But what I'm really trying to have people understand is it's a overused word, is the disruptive technology that's been happening nowadays. Especially, for example, software as a service. You can get companies that come up with an application product or some other type of service that they release out to the public, and the stocks literally explode because the earnings are there. Because you can get, take obviously the Apple App Store, where people can download tens of thousands of copies of an app, and somebody can make a lot of money. The same thing is happening in business, and I think a lot of investors have been caught off guard with how quickly this disruptive technology is taken over. Just for example, the whole cash to plastic play, we've seen accelerate dramatically in the last 9 months. It's always been around the last 3 years, but the last 9 months is just blown up big time. So,
what's been the biggest change for RIA firms over the last 3 years?
I really think the biggest change has been two different areas. One, mergers and acquisitions. Advisors are getting older. We've seen a lot of smaller local advisors, firms get bought by bigger regional. I think the regional RIA firms understand that they can bring scale and they can do things a lot more effectively. But I really think probably the biggest change has been how we communicate with clients. So, 2017, 3 years ago, was not that long ago, obviously in time, in a timeline, but from a social media standpoint, 3 years ago might as well be 30 years ago. And I remember, when we first started this broadcast on Twitter, it was very innovative, thanks to you. But now we see ourselves reaching out to clients in many different ways. We're on Facebook, we're on Twitter. We're producing videos and sending them to clients. Has become, for RIAs, a much more accepted way to communicate, their thoughts and their strategies with clients. And clients are much more accepting for it as well. And I believe if an RIA firm's not doing it, they're going to end up, being dead in the water.
I think it also helps to personalize the experience for the client as well. It gives them a little bit of an inside look. Chris, even what we're doing now, I think, do I miss being face-to-face? Sure, but even doing trade talks virtually, you're in my living room. In fact, this, in honor of our third anniversary, this is the first time we're using the shop behind me, so you were the guinea pig for that. But honestly, it personalizes it a little bit. This is my home. I can see where you're working from. So it really is, when we talk about disruptive technologies, we are doing all of this from an Apple iPad. We're doing it from Zoom video. These are all Nasdaq 100 modern day industrial stocks that is bringing trade talks and a number of other media to clients and guests and so forth. But Chris, let's go through the charts as we do each month. Let's start with the S&P 500.
Yeah, obviously what we've gone through this year, if anybody looking at these charts back in February thought that we'd be knocking at all-time highs, we are literally 20 points away from all-time highs in the S&P 500. So what's an interesting statistic is that this is the biggest 100-day trading jump since 1933. Now, I don't like to go back to like the late 20s and early 30s because some people have bad connotations about that period of time. But just to show you the magnitude of the recovery that we have had, it's been tremendous. I mean, who would have thought that we would have seen the markets recover that quickly when we're back in February and March.
Let's talk about the Nasdaq 100 again. Those stocks that were leading the way pre-COVID-19 certainly led us in the stock market recovery and continuing to hit all-time highs. That said, do you think it's time for perhaps a little consolidation here?
Yeah, and it's funny you mentioned that because I've been going back and forth with some value money managers, and remember, like last summer we saw large cap growth take a breath and value come on, and it looked like it was going to happen in the fourth quarter. Large cap growth just kept going, and then at the beginning of June this year, it looked like large cap growth was going to take a breather, and value was coming back on. But interestingly enough, since the middle of July, we've actually seen the performance of large cap growth and large cap value really, going neck and neck. So I would not be surprised, and we think one of the themes, and it would actually be healthy for the overall market if you saw some broader participation and you saw the quote value stocks start to participate. And I think, if you're an income investor, and we've talked about this before, you're really going to start to take a hard look at the fact that these dividend stocks, i.e. the banks and i.e. the energy companies, are beginning to get very attractive at this level.
Well, speaking of that, let's take a look at the small caps, the Russell 2000. You're starting to see a little bit of participation from there. But again, the Russell 2000, you have energy in there, you have financial in there, and that's part of the reason why it was lagging.
Yeah, and so I think this actually makes the market healthier. The fact that we're seeing some broadening out. I mean, a lot of the bears were out there talking about, hey, this is only a 5-stock rally in the Nasdaq or the S&P 500. Everybody else isn't participating. Well, we've actually seen other asset classes and also other capitalization structures like the mid-cap stocks start to participate. So again, I think it's healthier overall to see this general participation that's happening. Whether or not the Russell really explodes from here is anybody's guess, but the fact that it's doing better is actually better for the overall tone of the market longer term.
All right, and of course, oil, back up to the $42 level and some change there. Supply demand picture though, still it really hasn't changed much though.
Yeah, it hasn't, and this is something we said a couple of months ago, how we thought some of the markets were going to start to go to sleep and before the elections not really do anything. We're going to make a call. I mean, we made a call last year that we thought coming into 2020 you were going to see higher oil prices, and that was obviously disrupted by the whole COVID situation. But we think oil is starting to really build this base, and one of the outliers that people aren't really expecting going into 2021 would be higher energy prices. Demand is beginning to recover. The airlines are flying, etc. If the economy begins to pick up, there could be a surprise on the upside with regards to oil.
And 10-year Treasury rates, they're going to be at low levels at least to the end of 2020.
Yeah, I mean, the Fed has said to us, that they don't expect to raise rates anymore. They want the economy to heal, and they want to keep interest rates low. Surprisingly enough, there has been a short-term breakout, a move to the upside. But again, until we start seeing, 1% on the 10-year Treasury, we don't really think it's going to be that big a deal. We think rates are going to stay lower for longer. And we actually think investors are going to have to scramble, especially income investors looking around for other things to be able to get some kind of income off it. Now, one of the points that I want to make, and obviously we'll get into this in the next couple of months before the election, is a lot of people are concerned about what's going on. I got a note from a money manager the other day saying that he was seeing something he never saw before, that there's literally $13 trillion sitting in cash on both corporate balance sheets and personal balance sheets. People are sitting on a ton of cash. They don't know if the economy is going to shut down again, etc. And that cash is going to have to go someplace in the next 6 months. And we think that there's going to be a lot of movement going on.
Yeah, it'll be interesting to see how that impacts the M&A market. I mean, certainly in financial media, they've been talking about that, those, companies like Apple that just have so much cash on the balance sheet. So could be interesting from an M&A perspective as well. But Chris, let's talk a little bit broader to wrap up here. We'll meet in September, we'll meet in October. By the time we talk again in November, we will either have a new administration or another 4 more years of Trump. In addition to that, in the race to a vaccine, how are you advising clients? Of course, everyone's portfolio is different, but is it, keep some powder dry, put some money to work, what
Yeah,
are you doing?
I call it, have as much cash as you can sleep at night kind of method. I mean, we have been trimming some extended positions. We're not, rushing to put money back to work. But one of the things I try to tell clients all the time, we touched on this the last couple of months, is that if you make a major asset allocation decision based upon one event in the future, you could end up really affecting yourself longer term. So if somebody says today, hey, you know what, I'm going to go all to cash, right now, and I'm going to wait to get back in until after the election, we think that's a mistake. I mean, if you are concerned about it, keep, some higher levels of cash. But remember, once, we've had the election, you're still going to have to invest for your either, your retirement or your eventual retirement or your kids' college education. So to make those big asset allocation changes before, radical asset allocation changes could hurt you much longer term.
Yeah, well, look, if people were doing that, over the past 3 years, everyone was concerned about the inverted yield curve and all the other number of events that happened, especially in the last 3 years in the news cycle. Look at the returns you would have missed out on the S&P 500, certainly the Nasdaq 100. So I think it does make sense to stay invested and have cash that you can be comfortable with. Chris, as always, thanks so much for joining us on Trade Talks.
Yes, thank you, Jill. And 3 years down, let's do another couple of years.
All right, you got it. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.